Hey everyone, and welcome back to How to Spend It. We all know about passive income, right? Passive income is money you earn that doesn't require you to do a lot of active work to continue making it. Unless you're one of the lucky few employees who have an employer-provided pension, you probably are on your own when it comes to funding your retirement. So in the time of your retirement, the passive income sources could come in handy. But with the thought of passive income comes a big question to most people's minds. Can I live off passive income only? Well, the answer is yes. Yes, you can. You can potentially live off your investment dividends. That brings us to the second question. How much money would you need to live off dividends? Now that is the exact thing we will be discussing in today's video. Before we get on to that, go ahead and like and subscribe if you haven't already. It helps us out a lot with the YouTube algorithm and it lets us know that we're helping to enrich lives out there. And without any further ado, let's get on to the video. Now, for those who are new in the investing field, let us first talk about dividends. A dividend is a share of profits and retained earnings that a company pays out to its shareholders. When a company makes a profit, it can choose to reinvest that profit back into the business, or it can pay a percentage of it back to its shareholders. So, not every company pays dividends, but there are certain companies that give regular portions of the profits made to investors who own that company's stock. Dividends can be issued in various forms, such as cash payments, stocks, or any other form, but most dividends are paid out as cash to shareholders. A company's dividend is decided by its board of directors and it requires the shareholders' approval. Companies usually pay dividends quarterly, though some pay monthly or semi-annually. So in your retirement, or simply if you're looking to join the FIRE movement, stock dividend is a good source of achieving passive income. Yes, you heard that right, FIRE movement. It stands for Financially Independent, Retire Early. It's a movement that encourages people to search for alternative sources of income other than that 9-to-5 job and retire at an early stage in their life, as early as in their 30s. So stocks that pay dividends can provide a stable and growing income stream because stock dividends tend to grow over time, unlike interest from bonds. Investors typically prefer to invest in companies that offer dividends that increase year after year, which helps outpace inflation. Okay. Everything is looking quite good till now, and you're thinking of starting investing in dividends and quitting your job. But hold your horses. What you have to clearly understand is that living off dividends is not a get-rich-quick scheme. It takes time to accomplish that independent state. What you got right is the first part. It is important to start early for a successful dividend retirement plan. Make sure to stick around to the end because we will go into how much someone needs to invest to live off a financial portfolio. Now let's dive into the numbers. Let's say your annual expenses are $40,000, and following the rule of thumb, we have to multiply your yearly expenses by 25, which gets us to around $1 million. Now this is the amount you have to invest in a dividend stock to ensure a $40,000 annual income. This is a 4% annual yield. There are some important factors that are to be considered if you're looking to solely depend on your dividend for your expenses. Before jumping into that, let us tell you about the two major factors to consider when investing in dividend stocks. Dividends can be a great way to generate a regular income from your investments, but as with any income you earn, you have to pay tax, and it applies for dividends too. If you choose not to touch this dividend or even decide to reinvest in more stocks, you would have to pay tax for the money you got as a dividend. But the good news is that income tax on dividends is lower than the regular rate you'll pay on money from work or a pension. Dividends can affect the price of their underlying stock. When a dividend is paid, the stock price is adjusted downwards by the amount of the dividend. To put it in layman's terms, when a company pays a dividend of a certain amount that says $0.5, then its stock price will drop down to $0.5. Now, many people take advantage of the dividends by buying the stock right before the payment, and after they receive the payment, they sell it immediately. And this process is called the dividend capture strategy. But it takes good timing, organization, and market awareness. Now let's talk about the benefits of investing in dividend stocks. The dividend yield shows how much a company pays out in dividends each year relative to its share price. To be more specific, a stock's dividend yield tells you how much dividend income you'll receive in comparison to how much you invest. The dividend yield concept is used by investors to determine which shares will pay them a higher return on investment if they were to purchase the shares. But how exactly is the dividend yield calculated? Examples make everything easy to understand, so time to work with some numbers. Let's assume you bought a dividend stock at a price for $10, and the stock will pay you a dividend of $0.1 every 4 months, meaning you will get $0.1 for each dividend stock in every quarter, bringing it to about $0.4 from each share at the end of the year. Now, the dividend at the end of the year, which is $0.4, will be divided by the price of the stock, which is $10. So $0.4 divided by $10 is 0.04. Now, this 0.04 will be converted into percentage, which gives us 4%, and this is the dividend yield of the stock that you bought at $10. Well, we know math can be a little bit irritating for someone, but investing in stocks does require some mathematical analysis, at least in the beginning. So, for example, we could see that buying stocks with a high dividend yield can provide a good source of income. New companies that are relatively small but still growing quickly may pay a lower average dividend than a mature company in the same sector, as they're looking to reinvest their earnings into the growth of the company. Now let's take a look at a dividend yield from another perspective, which would help you to understand it a little bit better. Let's continue from the previous example. If you invested $10 in stock A, let's assume there is another stock, say B, which is offering a lower dividend yield, 2%, but you want to receive $0.40 dividends from each stock per year. In that case, what would your investment need to be in stock B? Let's reverse engineer and break the 2% yield into numerical terms with regard of $0.4 per share. Therefore, the investment has to be $0.4 divided by 0.02, and that equals $20. That is double the first company's investment, meaning if you want to invest in company B, you would have to invest twice as much as in company A for the same dividend income because it has a lower dividend yield. All of that shows us that the lower the yield, the higher the amount you will have to invest. So you have to understand the difference in yields and have to find out the dividend stocks that have a good dividend yield compared to other companies in the market. That doesn't mean you have to invest in only high-yield companies. Several companies use this bait to gather more investors. Sometimes thorough market research is needed before investing in a company. As we're entering into the last part of our video, make sure to like this video and subscribe to our channel. If you've been researching dividends, you've probably heard of the dividend growth strategy. Basically, investing in companies whose dividends have the potential to grow and whose management tends to increase dividends. It doesn't have to be annually or even a substantial increase. A simple increase is enough for the strategy to work. That's what a dividend growth investing strategy looks like. While looking to invest in dividends, you should seek the stocks of companies with a solid record of increasing their dividend payout per share on an annual basis. Companies that do this are generally well managed and financially sound. The ability to sustain and increase the dividend payout each year is a sign that the company is growing its bottom line and is generating solid cash flows. This strategy is for investors who are seeking a long-term payment system, and that is why it's a great one for people who are thinking of relying on dividend payments. Income generated from dividend growth stocks results in far more money staying in your pocket than many comparable investment assets. A quality dividend growth stock can provide you with a rising income from your investment, which you can then reinvest into more shares, creating an exponentially growing income stream over time. Dividend income and capital gains have become more attractive sources of passive income for investors. Capital gains tax rates tend to be more favorable than income tax rates and depend on how long the seller has owned or held the asset. Short-term capital gains for assets held for less than a year are still taxed at ordinary income rates. But if you held an asset for more than a year, then the preferential long-term capital gains apply. For the 2020 tax year, you pay 0% on long-term capital gains if you have a total income of $40,000 or less, 15% if you have an income of $441,450 or less, and 20% for income above $441,450. So when you reach the $1 million portfolio with a dividend interest of $40,000, you can get into a steady stream of dividend payments. And if you can keep your income from dividends at or less than $40,000, then you can also enjoy a 0% tax. That's a pretty great system, right? By investing in quality dividend stocks with rising payouts, both young and old investors can benefit from the stock's compounding and historically inflation-beating distribution growth. All it takes is a little planning, and then the investors can live off their dividend payment streams. These are helpful facts which are not recommendations. Investing can be risky if risk is not managed. Do your own research and do not follow the mass. Form your own opinions and start investing. Well guys, that's it for this video. Click the links above to check out some of our other videos. Also, don't forget to like and subscribe for more content just like this. We have many great videos coming up, so see you guys in the next one.